Hello, my name's Barney Hawkins, Investment Director at True Potential. Today I want to talk about the savings gap. What is it? Well, it's the gap, the difference between what people need to save for their retirement and what people are actually putting aside. It's a difficult subject. Which is better, a pension or an ISA, or both? How much, what level of income will I need in retirement? What will that figure be after 10, 20, 30, 40 years of inflation? What size of pension pot, what level of savings will be required to generate that sort of income? What level of growth can you expect from your investments? Lots of difficult questions. But quite often the more complex a problem appears, the more simple the solution can be. What we do know is that most people need to save more than they are, and the earlier you start, the better. It's also worth bearing in mind that state provision, the old age pension, is likely to get smaller and the age you receive it go up as the years progress. It's important to get advice, so speak to your advisor or get in touch with us through the website. But let's have a look at those questions. Which is better, pension or ISA? Well, each has its own advantages. With a pension, your contributions are made from tax-free income, but when the pension is paid, it's subject to tax. With an ISA, there's no tax relief on the contributions you make, but any income is paid out tax-free. ISA investments are more accessible than pension funds, which can be a good thing or a bad thing. It depends on how disciplined you are. There are also separate rules for pensions and ISAs on how much you can contribute and how much you can build up in each vehicle. The answer is that it's probably good to have both. The biggest question is how much income you will need in retirement. Everyone's different. It depends upon your current lifestyle, what plans you have for retirement, what age you plan to retire. As I say, everyone has their own idea, but research True Potential has carried out, polling over 40,000 people since 2013, suggests the average income required for somebody retiring now is around £23,000. The next question is what size of pension or savings pot is required to generate that sort of income. Again, it's not an exact science and depends upon a number of factors, but a reasonable rule of thumb is to reckon on your savings generating a sustainable return of about 5% over the years. This means your savings pot needs to be 20 times the income you require. So to put this into context, to generate an income of £23,000, you need a pension pot of 20 times that, or around £460,000. It's a big figure. That's why the earlier you start to think about it, the better. Potential growth is subject to lots of variables, particularly around how much risk you feel comfortable taking with your money. That said, using long-term numbers from Morningstar, a balanced portfolio might be expected to return an average of 5.5% per year, and an aggressive portfolio a return of closer to 7% per annum. But these are long-term averages. Obviously, returns fluctuate from year to year, and some years are better than others. Our tools can help you establish your attitude to risk and calculate how much you need to be putting aside on a weekly, monthly, or annual basis to get to your target. Using our goal-based investment process, you'll be able to track your progress towards your long-term target online or through our mobile and tablet apps. Using Impulse Save, unique to True Potential, you can easily top up your investment at any time with as little as £1. As I said, markets don't go up in a straight line, and there may be short periods or longer periods of volatility when markets are falling. Now, these times are uncomfortable, but they're part and parcel of long-term investing. And actually, volatile markets that go up and down generally benefit long-term regular savers by allowing your monthly investment to buy more units when prices are cheaper and fewer when prices are higher, so bringing down the average cost of your investment. It's called pound cost averaging. So don't be scared or put off by the prospect of market volatility. As I said at the outset, it's a complex area. There are lots of variables. That's why it's easier not to think about it. There are also lots of calls on our money, lots of things to spend it on. Holidays, a new car, a mortgage, children. It's important to work through these various considerations and understand how much you should be putting aside. Don't put it off. The sooner you start, the more comfortable retirement you'll have. I hope this has helped, and thanks for watching.